Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge here to give you a strategy of the week update for our agricultural markets. In lieu of a Zaner market cast this week, we're going to be doing a little bit of a different format here, getting a little more technical, diving down into some charts. My partner in crime, Joe Nacrudo, couldn't be here today. Hey, Joe, if you're listening, I hope everything's well with your family. He's dealing with some personal things today that can't make it, so hopefully everything's going well for him. But with that being said, let's just jump right into it. The typical format here, folks, that I do is, we'll go over some charts, mainly start with some daily charts, kind of break down what we're seeing on the daily and the weekly time frame, and then even drive down a little further here into some smaller sub time frame charts, maybe talk about some spreads. But before we get into anything, let's update us with a little bit of our news today. Thanks to Karen Braun from Reuters here, publishing this great breakdown of U.S. net export sales for the day, for the week, I should say. Unfortunately, just abysmal sales and actually marketing year lows for wheat and beans here today. 141,000 metric tons of wheat sold, way below trade estimates, bringing year-to-date totals to 16.9 million metric tons. But again, that's only 11% of the year-to-date total compared to last year. Corn, again, below trade estimates, not a marketing year low, with 770,000 metric tons for delivery for the 24-25 marketing year, bringing us to 38.8 million metric tons, and that's 30% of our USDA forecasts. Beans, a marketing year low. You can chalk these numbers up to, of course, being holiday markets and thinly traded business plans, but 485,000 metric tons there, only 11% of our year-to-date totals at 40 million metric tons sold. Soy meal 204, kind of right in the middle of expectations there, and soy oil 38, beating trade estimates. So seeing larger amounts of bean meal and oil being sold this year, not something we traditionally see, as many of our export partners that take soy complex products prefer to do the crushing themselves to get that value add on their balance sheets rather than giving that business right to U.S. or South American crushers. All right, let's begin today with let's just begin with corn, because I do think while corn closed down 8 3/4 cents on the day here for March corn, we were able to hold up pretty well on the weekly chart. It looks like we closed, well, could have been only down about 4 cents week over week, but certainly well off of their highs here for a weekly close, and right back into, you can see that old high from December, as well as the old highs here from October and into September there on the corn March weekly chart. Kind of getting rejected at that downward sloping trend line, and it looks like the 55-week moving average as well. And then, if you're big into math, that 50-week moving average is not so far off from your 200-day moving average, which in this case actually held up as support here at 448 and the lows of today. You got that 18-day red moving average here coming in as support as well. 55-day is still well below us at 437 3/4 or 1/4, with the 100-day even below that, and now kind of aligning with that upward sloping trend line that held against the lows since August on this chart. Again, we are back above those old highs, from October and November respectively, but we did get rejected up around that 460 area, which is that old contract low that we began this year off with in February, that we took out in the summer months, slid below, and it's hard to call this anything but consolidation now below that point. But again, this chart gets very bullish again above 460, above that downward sloping trend line on the daily chart, as well as after holding the 200-day and 18-day moving averages, kind of breaking above, now back and filling to hold that area as support. Let's take a look at the smaller time frame for corn. Look at the March corn chart, 4-hour chart now, a lot of the same levels on it. The dots that you see, or the lines, the red and blue, represent the monthly highs and lows. The purple and magenta, or the cyan and magenta, I should say, represent the highs and lows for a daily candle. Outside day lower to start us off here for the second day, full trading day of the new year. Not a good look. closing below that range low at 450, or going below, I should say, but closing back in kind of gives you a little bit of hope that this could have all been a pullback into support. And if we clamber back above, 454 and certainly towards 459 and above, this market just looks like it had, took a step back to test old resistance now as support. You got to worry a little bit if we slip below that 450 area because it's going below the the 200-day, the 18-day moving average, getting below the old range highs, and this does then look a lot like a head fake and maybe a lot more like wheat or beans are looking recently, which we'll take a look at here in a minute. But back below the lows of today, corn, next support to the downside really doesn't come into me. Come into the charts for me until around 440, but even then, this upward sloping trend line at 435 could be the next place to find that support. Below there, you're back into your old range. Contract lows around $4 maybe come within striking point, and it doesn't sit well for the bulls that this entire rally was just up into this 50% retracement of the old swing from 509 highs down to 403 lows. So if we do take out contract lows, downward targets towards 380 could be in play, but we don't need to talk about that just yet. This is still some lightly constructive price action. I still see this as the market having broken above some technicals, testing with support, and into money's price action, we might have a clearer picture for the corn. New crop did not change my opinions of it very much. I think we're a little bit more of a range-bound market here until we're not. So for December corn, kind of stuck below 450, but above 430 for the time being. This looks all like chop, since September. Nothing's really changing in my opinion there. And we will pay attention to some of the spreads here going forward. And why don't we just take a look at a couple of them now. Got to update them real quick. Here's the March D's spread here. You can see that the March 25, D's 25, so this is an old crop, new crop spread, basically the widest we can get, traded from 30 cents under, which, let's just check out what full carry is on that bad boy. Help if we looked at corn. March D's corn here, full carry for that March 25 to D's 25 is $2.35. So 30 cents under represents a seventh, or about 10% full carry, and right now we're at minus 8%. So because it's an inverted market right now, does not make with March above, right? December corn doesn't give you much hope there, in my opinion, for continuation of those spreads higher if outright corn's about to flip. And honestly, if you haven't done sales yet, or you're looking to roll or capture some carry, I think there's an opportunity here and somewhat limited risk in this environment where we don't really have a narrative for being overly bullish corn. Don't get me wrong, there's reasons that the market has rallied, there's a reason the funds are now long, there's a reason that we traveled up to 460 in March corn here. But is it the type of environment without a weather market, without real weather issues in Brazil and South America, where we are continually seeing the raising of crop forecasts? Is there a reason to think that we have a supply concern with corn, that we need it now and we're not going to get it later? If not, this market doesn't belong above even money at zero, and we should expect carry to be built into this. And I oftentimes look at these calendar spreads early and at the first of the year, because if we're inverted or there's plenty of carry to be built in, there's a lower risk opportunity there for producers and for hedgers to try to capture some carry in their marketing plan than just selling outright futures sometimes. Don't get me wrong, these can become widowmakers and blow your head off if you fall asleep at the wheel, but when inverted market conditions, only require an act of God or a black swan to prop themselves up. But if corn is topping out in a day that we're down 10 cents and the calendar spread has fallen, 3 or 4 cents as well, watch out, pay attention, and there could be an opportunity there. Because again, this thing can trade, all the way down to, $2 under from where we are here today. All right. Let's move on forward with our discussion of, let's take a look at soybeans here. And we'll do some cattle. Take a look at the cattle markets because they've had an impressive run over the last couple of days as well. But March soybeans, I'm not paying too much attention to Jan, but similar idea here. The March beans had a little bit of a head fake here, only spending a day and a half above that old broken trend line that you can see here on the chart. Began from way back in March of 2024, held again in September of 24, held again in November of 24. We then, of course, went down and capitulated and came back up to break above it, only staying there for about a day. The 55-day moving average was holding a support as well as the downward sloping trend line around that 1002 figure from yesterday's trade. The 100-day moving average at 1020 seems to be some form of resistance for the time being. And I also want to point out that we have not been above 1020 in March soybeans since October 14th or 15th. And you can see here, with the exception of 1, 2, 3 days, these are the only days right here in what was effectively like a little head and shoulders pattern, in my opinion. Left shoulder, head, maybe the right shoulder here really didn't have any chance to run up. And then we capitulated to our contract low with a neckline at old contract lows. We have not been above that 1027 to 1020 area since basically mid-October. We came back up there to test it yet again, got rejected, and now we're back down into that old range that we were in before we capitulated to the contract lows. We're still holding above our prior contract lows, which is kind of a good sign, so to speak, and held that 18-day moving average. You can see here at 991 as support today, but you slipped below today's low, and now you've taken out last week's lows and are unwinding the entire rally that we had from contract lows, which is not a good sign. After a failed breakout, attempt at that trend line, the 55-day moving average, failure to get above the 100-day, and now we are no longer overbought in our RSI. So could be a signal for a top, but some volume comes in here and they take it back up the other way. This market gets pretty bullish back above $10 and certainly back above 10.15 and around the highs of today. That's what opens the door for talking 10.50 prior highs from November, and even $11 highs from September. But we get below today's low, below that 18-day moving average, below the old contract lows. The market has already proven to you that between 980 and 940, there's nobody home, and we will very likely continue straight down, in my humble opinion. Volume was a little bit of declining today, but it has been the start of a new year, so we'll see. Volume was declining the last 2 days of in the rally. Volume declining on this pullback just means that I think that a lot of the longs that bought this market up are still holding, and if we slip any lower, that's when we'll probably start to see the panic selling. So I am very worried here that this was a bit of a fake out, and bean markets could be coming under pressure. I also want to point out that over these last couple months, we have seen some bear spreading on green days and bull spreading on red days. Basically, we ran up to highs in our March July spread here. We ran up in highs to 18 cents under, hit that 18-day moving average. I mean, they were bull spreading here on the way down for beans and then started bear spreading on the way back up. Today was the first day where I don't want to say they weren't bull spreading because it was a green day, but they were unable to really make progress with it now that we're below all the spaghetti trails of our moving averages. There's still a bit of a trend line on the lows, and you could call this a bit of a bear flag. I'm not exceedingly bullish on this. I think it makes sense to me to see this continue to unwind, and particularly when we look at the old crop, new crop, July, November spread. And again, let's take a look at how far down this thing can go to full carry real quick, which I already generally know that it can get to a dollar under, but 80% of that's going to be about 85 to 90 cents. $1.15 under is full carry on this spread, and we are currently inverted. Last year, this is so reminiscent of last year. In fact, last year we were like even more wildly inverted at this point in the year. They were like up in the 50 cents over range. This market's been unable now in the recent rallies to take out some of those prior levels. that we've traveled below 25 cents over, 17 to 18 cents over, got above it there a bit, but it's been capped. We've been really consolidating sideways. And now, the market, for whatever reason, is staying inverted at a time when I don't see the justifiable narrative for a shortage in soybean supplies that would demand consumer or commercial needs now to keep this thing inverted. So if there's going to be a carry trade to capture again, as we start to bear spread this lower, take out these lows, get under, go back to even money and start going under. Building that carry back into this market means that this spread has the ability to trade, 80 cents lower from here, and until it gets to that cash and carry levels of about 80 to 70 to 80% full carry, and that's something that decisively last year kind of occurred into plantings as we start to sober up on the idea that we'll be planting soybeans again. There's another crop coming down the pipeline, and the market starts to prepare for that inevitable windfall of grain. And without some kind of act of God or weather event to create that, add that fear index back in that there isn't going to be grain for the future and we need it now, the logical and economical, textbook, dynamic says that, hey, this market and this spread could very likely continue lower, and the bear spreading that we've seen going on in the old crop, new crop bean spreads was not indicative of the rally we saw at all in the outright futures, right? From the time we made a contract low in the beans and rallied, they've been bear spreading July Nova beans, and that's not a great sign for the long-term trend. Short-term, March beans today broke below their kind of rather steep upward sloping trend line they had been holding. Again, they clambered back above the old contract lows and everything, and technically have just pulled back to hold some of those levels, now as support. But this looks like a proverbial head fake above that old downward sloping trend line. So unless the trade can pick this back up and push it back above that 115 area and certainly back above 10, again, below 980, the market's already told you there is nothing but air back down to 940. 50%, 50 to 61.8 lines kind of held in the last swing up for the beans. So very technical kind of area that we rolled over from as well. And, it's hard to pick out support if it's not here between 990 and 980 already. Full 50% retracement off the lows comes in at 981, that old gap area that filled on the charts the same day. But we did gap up there, right, on last Thursday, or 2 Thursdays ago, excuse me. And a pullback into 980 to test the old contract low area. Not out of the question here, as that's a 50% retracement. So watching that, if we get reactions from there and it goes straight up from there, you could have a trending market higher. But I'm afraid that some of the other writing on the wall right now, going into a time of the year where we know Chinese participation in export markets slows, into February and into the end of their year. Especially with, and then with what have been upwards revisions in South American crop forecasts. If this market can't technically hold it together, what's the story here, bulls, right? And as bullish as I want to be, and while we can find a better technical picture to be bullish, corn still having just back and filled, so to speak, into old broken resistances now support, it's harder to find those levels having held here on beans. Beans should have been held up above $10 here today, and they even got a reaction off of it into the early morning before getting slammed down for really the rest of the day. And not a good look to unwind almost all of last week's price action in just one day's event. So we will see. Bean meal and the oil. Let's begin with meal because it's got a little bit more of a technical picture to talk about. Right up into that downward sloping trend line. Didn't quite make it to 324, but 320 top was also into the 50 to 61.8 line of this downward, this downward measured fib. Rolled over, broke below the similar upward sloping trend line on the outright bean chart. So meal and beans highly correlated right now. This is a meal-driven rally for the soybeans. And I think that's all it was. And we saw that in demand, right, in export demand. Meal and oil were the demand products, not beans. And they effectively drove and pulled the price of outright beans higher here when outright beans prices maybe weren't justifiably, you know, demanded from an export perspective or from other things, right? And domestic crush has been what it was, but seeing meal demand and oil demand could cause more domestic demand and more demand for beans. But the problem there is that we're generally pretty tapped out on that domestic demand. And bean processing is a pretty well-known number that only adjusts by a small amount, not enough to make in my humble opinion, a massive dent in our carryouts right now. At least not domestic demand. It's just not the way the the economy of soybeans works. So that open gap down at 302.30, I think, has got a, at this point, I think it's got a target on its back. You got a 50% retracement now off the lows around the 303.40 area. So technically speaking, I think there's a lot there that the market should come down and test and prove if it wants to be support. And if it doesn't, well, I mean, this market's got the bean meal market meal market is a long way down to its prior lows there. And certainly, I think some of the earlier this year, I think some of the excitement, basically from our summer months through November, there was a lot of excitement about oil. And I think we had mostly an oil-driven market because of the hopes for SAF solutions and some guidance there on that becoming a product, but the sobering reality that it is still probably years away from really having a dynamic change in the bean market left us kind of wishing and wanting and reversed that entire uptrend. So 4-hour chart broke back below this upward sloping trend line. It seems to be now trending lower, holding downward sloping trend lines at this point. The market basically just consolidated. And I would be hard pressed to believe that we don't find a new low here in bean oil here into next week. Given the sell-off that we just saw, this market kind of seems like it wants to take out the lows from November at this point, January and December at this point. And at that point, you're pretty much talking the 38 low from August coming into jeopardy too. So watching that as well. In our wheat markets, we've got another down day. The 18-day moving average and downward sloping trend line against the highs held there as resistance. I apologize. I think I've realized I may not have switched over for the beans to the bigger chart here for the daily chart, but that's okay. I guess I can hop back there real quick just to take a look at it for you in case I didn't. Not much to see there, when I'm talking about this capitulating. Left on the small chart there for you, this capitulating moment, the 18-day. I mean, you can see the levels that you would have hoped the market held above and is justifiably maybe barely hanging on to those old levels, as well as that 18-day moving average as support now. So anyway, we looked at it on the 4-hour chart. It's close enough, right? Wheat, Chicago wheat here. I mean, if there's any indication of what the bean chart could do, right? Wheat went down, capitulated, came back up, held that trend line again, and then got smoked down to new lows here. So this is not so different of a look to our wheat chart, our bean chart. We were overbought conditions. We've unwinded that. Now we're heading down. We'll probably be oversold by Monday in our daily RSI. Increasing volume here, folks, on the March wheat. So not a good look. If you were hoping that the prior contract lows there were going to mean something, and finding that 18-day moving average basically as resistance, as we only spent a day or two above it and then got smoked below, seems very reminiscent of the last time we tried to get above that 18-day, failed, and held that downward sloping trend line yet again. So in the shorter time frame, however, $50 retracement from the 570 highs to the lows here, 61.8 to 50% area held as resistance. Downward targets 520 and 504. From that swing, are projected downside targets at this point. You've also got, a bit of a channel, I guess you could say, running lower here for the wheat, where, okay, we could be coming close around that 520 area, around that downward, channel support area. But generally speaking, right, wheat was holding this upward sloping trend line, constructive higher highs and higher lows, failed at some daily technical indicators, came down, failed this trend line, and just flushed out. Any longs in this market just panic sold, it seems like, and I would not be surprised to see that commitment of traders this week really swing towards the short side after today's price move. It's KC wheat and Minneapolis spring wheat, just to give them a little bit of love and a quick look today. No new contract low there from KC wheat. A little choppier here down. Not as convinced it wants to go lower as the Chicago wheat is, but I feel it's going to be dragged to probably a new contract low here as well, closing at 539 on the day, down 12 3/4, with the Minneapolis spring wheat making a new contract low, having its finally having its kind of capitulating moment as it was holding up for the most of November, unable to break back above that 18-day moving average, and flushed out here with some increasing volume, down 11 3/4 cents. So I think wheat is trying to hunt out that next and new low. We're probably closing in on it based off of the wheat complex, how we're seeing that play out across the board. So we'll see here. I know not a lot of great news to report, but we got to talk about price action for what we're seeing rather than what we think. And the bulls gave it, and the rally gave it every chance it could. And now we're kind of stuck with the January having printed a very high-end price to start the month. That if we can't take out that high, I don't want to say it dooms the markets to head a little lower, but not a good look to start the month. As much as we would like some better prices to maybe get some sales done or take forward in this marketing year. Cattle markets, really strong day today that kind of reversed off of their highs. Printing basically a doji in that Feb live cattle. That's a nasty move, but we are having broken back above this old downward sloping trend line, trying to come back, almost testing below it for a moment there, and then breaking back above it. I don't want to say that this is the opposite of capitulation. This is almost your blow off top kind of moment. If we go and look at some deferred months, we have that blow off top actually into new contract highs. The Feb live cattle is the only one on the board price right now that was up around that 198 to 200 mark. Not saying we can't get up there, but it seems like after today's close, the market wanted to potentially test back, and there's plenty of old highs and broken resistance now to test the support, specifically down around the 190 area, these old highs, the 191 figure, and of course the 193 high from the month of December as well. April live cattle, similar levels here, but more congested around that 193 figure, so maybe 3 to 5 points lower for the fat cattle back into support. We're definitely overbought on the RSIs. We've had some increasing volume over the last several weeks, but this rather parabolic move in the cattle complex seems like we might see a pullback sooner rather than later. March feeders also breaking out into new highs here, and I think it's worth noting the Jan feeder as well. Not a new contract high, that's all the way up at 272, but certainly got above that old summertime top that had been more or less keeping the market down there through the month of December. March feeders finally broke out of that area as well. Would not be surprised to see a pullback here. 18-day moving average down around 258. That's going to rise, I think, to meet the market around that 260 figure to see if we can't continue this, this uptrend. And there's definitely an uptrend on these charts and a bit of a channel higher that the market's followed. And so I would not be surprised to see a pullback to channel support and those major moving averages below broken resistance, now support, before potentially winding up for that, more robust move up into contract highs, but we will have to wait and see, won't we? Well, that about wraps it up today for our strategy of the week update. You can always get in contact with me over here at Zaner Ag Hedge at 312-801-4231. That's 312-801-4231. You can find me on X at Daniel Hussey Jr., Dan SOTD on Facebook, or shoot me an email at dhussey@zaner.com. Leave a like, a comment below, sign up to be a part of our daily call-in, or shoot us a question for next week's market strategy, or market cast. And until next time, everybody, I'm Dan Hussey with Zaner Ag Hedge, and we'll be back with you as price action develops. Take care, everyone.